Hello, listeners. Welcome to Voiceover Work, your audiobook sampler, on this beautiful April 22nd, 2025, as Earth Day is creeping up on us. Today's featured book is Crush Debt Now, a three-step negotiation strategy to pay off debt and win financial freedom fast by Tom Cromwell. If you're drowning in debt and those pesky creditors won't leave you alone, this book is your life jacket. It'll teach you how to swim towards financial freedom with a three-step strategy that has helped loads of people just like you. No more stressful phone calls or court threats. It's time to take control and say goodbye to those money worries once and for all. Today's episode is Unveiling the Secrets to Financial Freedom. Are you ready to dive into some crucial money matters? Because today's episode is a real eye-opener for anyone who wants to keep their hard-earned cash and their beloved home. We'll be chatting about the importance of responding to legal stuff like summonses and why ignoring them can lead to some pretty nasty consequences. It's also time to talk tactics on how to avoid losing your house or having your wages garnished. Yeah, we're getting real here, so grab a cuppa and get comfy, because this episode is going to be an essential listen for anyone wanting to stay one step ahead of the game.
In this chapter, we're going to look at the process you will experience when creditors turn their debt collection tactics onto you. A subsequent chapter will then talk you through some of the strategies you can employ to fight back. So, you've realized that you're neck deep in debt, are struggling with minimum payments, and suddenly your creditors are hounding you from every side and making demands. This is very common. About 15% of Americans, or nearly 50 million people, said that they had been sued by debt collectors at some point, a staggering number. You can expect the debt collection process to begin once you're 30 days overdue if you make no payment. It will probably start with a letter or email, and the calls will start shortly thereafter. Initially, the calls are likely to be with the customer service team rather than specialist collections teams. Each organization varies, but the debt will not normally be transferred to the collections teams until it is between 60 and 90 days overdue. At this point, if you haven't spoken to them, then you'll probably get other emails or letters too. Some banks or lenders will continue to manage the collections and recovery process in-house until such point as they sell the debt. Other lenders will outsource this to an agency at an early stage. More banks are dealing with this in-house for longer, especially secured creditors. All debt collections calls will have similar characteristics. Those from agencies rather than the original lender are likely to be more aggressive and try to use scare tactics to persuade you to pay. We have a section below on how to manage these calls and talk through what to do and what not to do. This process is similar regardless of who is making the calls. From 30 days overdue, your lender will begin to report your debt as overdue to the credit bureau, and this will begin to impact your credit rating. More discussion of this in the next chapter. For unsecured debts, e.g. credit cards, store cards, medical, private student loans, at some point in the process, if the lender has exhausted their own remediation, they may sell the debt on to a debt collection agency. Your account is then in collections. This may also happen for some secured lending too, but they may manage foreclosure proceeding internally, only selling the debt if these fail. At some point, possibly around 90 days plus overdue, lenders may instigate legal proceedings. You may be served writs to attend a court hearing, as a result of which the lender may obtain a judgment against you to recover the debt. That essentially is the process. After that point, it will be dependent very much on the type of debt. Basic terminology. There are a few terms that we will commonly use throughout the book, but may not be widely understood. There is a more comprehensive glossary at the back of the book, but that is more tricky to use on e-readers, so I wanted to include selected terminology here. Creditor. This is the bank or lending institution, or a personal acquaintance in bankruptcy proceedings that a debt is owed to. Original creditor, OC. The creditor to whom the original debt is owed to. This is very important when dealing with debt collection agencies, DCA. Debtor. This is the person or business that owes a debt to a creditor. Credit reporting agency. These are the three major reporting agencies or credit bureau: TransUnion, TU, Equifax, EQ, and Experian, EXP, which list and then report the history of your credit. Delinquent and default. Delinquency occurs when a borrower fails to make a payment on their loan, whereas default happens when a person fails to repay their loan as stated in the contract. Creditors usually allow loans to remain delinquent before considering them in default. However, this depends on the type of loan and the creditor involved. Many consider mortgages to be delinquent once they are 90 days, 3 months behind in payment. Once you hit 90 days overdue with a payment, your loan will be reported to the main CRA as officially delinquent. Just one collection account, usually accounts that are officially delinquent are moved to collections, can cause a credit score to drop 50 to 100 points, but this won't last forever. Unless there are new negative events, your score will steadily improve over time. Collections may remain on your credit report for 7 years from the date of the original delinquency. This statute of limitations holds true for both paid and unpaid accounts, with few exceptions. Sometimes you can negotiate with a CA to remove the entry in a pay for delete. However, they don't have to agree to this, and in some cases, they are not able to do so, as it is the prerogative of the OC. Once you are 270 days overdue, it will be considered to be in default, and at that point, many lenders will charge it off. That is to say, it will be written up as bad debt in their financial accounts. Again, this is a rule of thumb and can't be considered hard and fast for all loans and situations. Note that the U.S. federal government allows student debt to be delinquent for 270 days before declaring it to be in default. Very often, this will be the point the original lender will sell the unsecured debt to a debt collections agency. Federal student debt is not treated in the same way, although a collections agency may be retained. Being in default will also be reported to the CRAs. How do debt collection agencies work? Debt collection agencies, DCAs, are businesses that are tasked to collect debts on behalf of creditors or lenders. In other words, debt collection agencies act as middlemen between debtors and lenders. There are two main types of DCA, namely hired collection agencies and agencies that buy debt from the original creditor. Hired debt collection agencies. These are the businesses that are tasked to collect debts that are overdue by at least 60 days on behalf of a creditor or lender. Hired debt collectors usually earn a percentage of the collected money, which varies between 25 to 50%. These agencies usually act as middlemen who collect various types of debts, including car loans, medical bills, car loans, student loans, and even utility bills. Hired debt collection agencies only get paid when they collect your debts and increase their earnings by collecting more debt. Debt buying agencies. When an original creditor has decided that pursuing debtors is not something they're prepared to do, they may opt to cut their losses by selling the debt to a debt buying agency. In most cases, creditors will bundle together several different debts with similar features and sell them to the buying agency as a package. Debt buying agencies usually purchase these packages through bidding. On average, debt buying agencies pay about 4 cents per every dollar of debt that they buy from a creditor. This, however, can vary depending on the duration that the debt has been unpaid. Older debts are usually priced much lower than recent ones, since they are riskier and less likely to be collectible. How do debt collectors operate? Debt collectors usually reach out to delinquent debtors via phone calls and letters to try and convince them to pay their outstanding debt. In cases where debt collectors are unable to reach debtors through the information provided by creditors, they may resort to hiring private investigators to aid their search. In addition to communicating with debtors, collectors also conduct investigations on debtor assets, which can be used as leverage in case the borrowers are unable to pay back what they owe. Sometimes debt collectors may report defaulting debtors to credit bureaus as a way of encouraging them to make payment. Poor credit ratings can seriously affect a borrower's credit score and make it difficult for them to secure loans in the future. It is important to realize that debt collection is a legally recognized business, so if you're behind on your debt payments and collectors start calling you, resist the urge to lash out at them. Ultimately, they're just people going about their job. In the next chapter, we'll discuss how to handle these calls when managing our debts. Help! I'm being taken to court. First up, don't worry. You're not going to jail. Debtors' jails are something from a bygone age. Getting served just means that you've been given notice of a lawsuit. You're served if you're handed a copy of the summons and complaint, or someone of suitable age is handed a copy at your address. If the lawsuit is against you, you are the defendant. If the lawsuit names you as a defendant, you must respond, even if you think the debt is not yours. The person or party initiating the complaint is the plaintiff. The summons and complaint, the process, are a statement of the claims against you and a notice of the lawsuit. The lawsuit now starts, even if it is not filed in the court. This is important because it means there may not be a court filing number. Therefore, if you contact the court, they may tell you it has no record of the case. But that does not mean the process has not started, as the creditor has up to a year from the date of service to file with the court. The language used by most collection agencies is designed to create fear. For them, that's part of the process, because they want you to settle. Once you're served with a lawsuit, you may be tempted to ignore it completely. And if you fail to answer the complaint, the creditor can get a default judgment after the 20-day response period, which means you've lost the case before it begins. You will not have a court date, and you will not have an opportunity to talk to a judge if you decide not to respond. Judgment. A court will enter a judgment against you in case the creditor wins their case or if you fail to show up in court. You will receive the notice of judgment entry via mail. The creditor may use the judgment to collect cash. Common methods used include garnishment, wages and bank accounts, property attachments, this can be any asset you own, and property liens. Liens apply to the building and land. State laws control the amount of money and types of property a creditor with a judgment can collect. These laws vary state by state, so you need to check the laws that apply to you. The initial debt amount may now include attorney fees, filing fees, interest, etc., anything related to the case. Receiving a judgment resets the date of first delinquency, DOFD, automatically to the date the judgment was made, and it is the only solution for changing the DOFD. The reporting time on debt, relating to the statute of limitations, is now 7 years from the time the judgment was made. The judgment stays active for 10 years, or 20 years in some states. Therefore, a collection agency has 10 years to collect judgment owed. In case they fail, a judgment to reset for an additional 10 years may be given. This means the collection agency can reset the clock indefinitely until the debt is cleared. Wage garnishments and frozen bank accounts. One of the strategies that lenders often apply to recover their money from a debtor is wage garnishment. Once a creditor has obtained a judgment, they can then get a court order to enforce it. This typically happens through a court that directs that your employer withholds a certain percentage of your paycheck and sends it to the person who is owed until all the debt is cleared. Some of the most common sources of wage garnishment include student loans, consumer debts, and child support. In all of these instances, your wages will be garnished until the debt is fully settled. However, just because a court orders your paycheck to be garnished, it doesn't mean that you have no reprieve whatsoever. As a matter of fact, the law puts caps on the amount that can be garnished from your wages in order to ensure that you will still keep part of your earnings for your own personal use. There are two types of garnishment which a court can order. 1. Wage garnishment. This gives your employer the authority to slash off part of your paycheck and hand over the money to your creditors. Wage garnishment generally happens when a creditor sues an individual who is indebted to them for non-payment and wins. However, there are several instances when a creditor can enforce a garnishment without a court order. For instance, non-payment of child support or failure to pay federal student loans. So, How much of your wage can be garnished by court order? Well, this generally varies depending on the state that you live in. Some states, like California, have a cap of 25% when it comes to wage garnishment. For ordinary garnishments, those not for support, bankruptcy, or any state or federal checks, the weekly amount may not exceed the lesser of two figures: 25% of the employee's disposable earnings, or the amount by which an employee's disposable earnings are greater than 30 times the federal minimum wage, currently $7.25 an hour, or $217.50. So if your disposable weekly income is less than this, $217.50, you cannot have your wages garnished. But every single dollar earned above that can be seized until the point you earn more than $290, when it reverts to 25%. Wage garnishments for child support payments usually tend to be very high, typically capping at around 60%. Student loans, on the other hand, have much lower garnishment caps, normally peaking at 15%. In some states, the law exempts debtors from wage garnishment if they're the head of a household or breadwinner for a family. While filing for bankruptcy can provide some immediate protection against wage and non-wage garnishment, it does not protect the debtor from garnishment once a court has ordered a repayment plan for all the debts owed. In instances where the money is owed for federal taxes, a court order is not required before a garnishment can be enforced. Usually the Internal Revenue Service, IRS, will send a notice of demand for payment to the debtor. This is followed by a final notice, which provides the debtor with a 30-day period to clear what is owed. If the payment is not completed by the debtor, the IRS will contact the debtor's employer and begin the wage garnishment. 2. Freezing your bank account. Non-wage garnishment. Creditors and federal agencies can seize your bank account and use the money contained therein to clear your debts. They do not always require a court judgment against you to do so. For account holders who have their loan accounts at the same institution as their bank account, the lender can access your accounts to pay the defaulted loans without filing a lawsuit or judgment. When you sign the loan, you give the bank full access to your account in the event of a default. Default is normally 270 days overdue, but actual timing would be defined in your loan contract and could be significantly less. If they have a court judgment, other creditors can get the bank to freeze your account to repay what you owe. The court order and judgment is sent to the bank and kept on file. You'll get notified that a creditor has levied your bank account. The notice will describe the bank account and will explain how you can claim any exemptions that will allow you to keep some or all of your money. If you owe taxes to the government, the IRS can freeze your bank account and it won't be lifted until they're paid in full. A frozen account means you won't have access to any of your money until the situation is resolved. This means you can't take out any money and scheduled payments won't go through. Because these payments will probably bounce, you'll incur a non-sufficient funds NSF charge. If you have money in your account, this will deplete your balance. If not, you'll dip into a negative balance, putting you into an overdraft. In this case, you'll have to pay additional fees and interest to cover the shortfall. There are some exemptions that allow you to keep some or all of your money, even if a creditor has a judgment against you. The amount you may keep from seizure depends on the total amount in your account, its source, and specific laws in your state. Some federal benefits can't be seized, like Social Security, Supplemental Security Income, SSI, or veterans benefits. Under this law, the bank must protect 2 months' worth of federal benefits if the funds were directly deposited into the account. However, if the garnishment relates to the recovery of child support, spousal support, federal student loans, or federal taxes, the bank can freeze the funds, even if they come from Social Security. SSI is protected from garnishment even if the debt is a government, child support, or spousal support debt. Seizure of property. When a creditor moves to court, they have the right to stake a claim on your property in a bid to recoup their money. However, just because a court makes a ruling that your property can be seized doesn't automatically mean your property will be handed over to your creditor. the creditor is obliged to discharge or satisfy the debt that is owed to them. If you are in deep debt and at risk of getting your assets seized, therefore, you need to know which assets are seizable and what strategies you can employ to minimize the likelihood of asset forfeiture. Once a judgment has been made by a court of law, the onus lies with the creditor to decide how to proceed with the forfeiture. They'll need to establish which assets are seizable. This is normally accomplished through a judgment debtor's examination, which helps to unearth the assets or properties that can be forfeited by the creditor. In addition to this, the creditor should have a good understanding of the properties that are exempted from seizure. Each state provides certain exemptions on a debtor's assets that can be claimed by a creditor. If all of the debtor's remaining assets fall under certain limits, then the judgment may be rendered as hollow or unenforceable. There are also asset protection trusts which allow you to transfer your assets to an independent trustee who shields them from creditors. Alternatively, you can transfer your assets to a spouse's name to put them out of the reach of creditors who may be trying to claim them. As a rule of thumb, you should always keep your business assets separate from your personal assets in order to avoid repossession by creditors. Debtor assets and properties that are seizable. When most people think of seizable property, the first thing that usually comes to mind is real estate. However, in a forfeiture claim, the assets that can be seized by a creditor include not only the house that you live in, but also assets that you own, such as cars, boats, and even hard cash. In some instances, this can also extend to your salary, financial assets, such as stocks and bonds, your deposit accounts, and even IRA accounts. If you file for bankruptcy, for example, a creditor can seek a court order to have your stocks garnished if they're held in a non-retirement account. Most people tend to assume that since they don't own the house that they live in or any tangible assets like cars or money in the bank, then a creditor can't seize anything from them. This, however, is a very fatalistic assumption, since a creditor who is determined to recoup what they are owed can stake a claim on virtually anything that you own. Nevertheless, there are certain exemptions that can protect you from losing some of your assets in the event that a court gives a forfeiture judgment. This, of course, varies from state to state. In most jurisdictions, a creditor is allowed to make a claim on your home, which means you can lose your house if you are unable to pay back secured debts. In the case of unsecured debts, such as credit card debts and payday loans, however, your creditor cannot make any claim on your assets. If you live in a rented property or a house that is owned by someone else, judgment creditors are also not allowed to claim it, since you don't have the right to give it away or sell it. If you give away a property that you own in order to protect it from forfeiture, your creditor may be able to sue you for attempted fraud. This may result in your property being repossessed and given to your creditor. Furthermore, you can be fined or prosecuted in a court of law for deliberately attempting to defraud your creditor. We'll discuss this avenue later in the book, among the more aggressive debt management strategies. A creditor who has a judgment against you can also go after property that you are entitled to but haven't possessed yet, especially once your right to the property has been firmly established. This may include salaries and commissions that you earned prior to or after the judgment has been made, severance pays, refunds, insurance payouts, royalties, and inheritance. One of the ways in which you can protect yourself from this process is to make sure that all your assets are owned by your partner, spouse, or other parties. A creditor doesn't always have to forfeit your property after a judgment has been made. Sometimes they may opt to attach a judgment lien on a property that you own, usually real estate, building, and land. A lien is essentially a notice which stipulates that you owe a certain debt. This is normally filed with the Register of Deeds in the jurisdiction where the property is located. A judgment lien gives a creditor the right to collect their debt from the money that is made from the sale of the property. In most states, judgment liens usually have a validity period of 5 years, and creditors are allowed to renew them until the judgment expires. However, there are a number of exceptional circumstances under which a creditor cannot seek a judgment lien. These include bankruptcy and foreclosure. Furthermore, a creditor cannot attach a lien on your property if there is one already in place. Foreclosures. A foreclosure is a process through which a mortgage investor or lender repossesses a house when an individual fails to make their mortgage payments. Foreclosures are often triggered by a change in an individual's financial position, which makes them unable to meet their mortgage obligations. Some of the most common causes of foreclosures include medical problems that make one unable to work, too much debt, and sudden unemployment. How foreclosures work. There are two types of foreclosures: judicial and non-judicial foreclosures. In a judicial foreclosure, a lender typically brings a legal action against a debtor to court. This usually takes longer since each step of the process takes a period of between 30 to 90 days. On the other hand, non-judicial foreclosures take less time and do not require court action. They are instead based on the power of sale close that a lender has signed with their borrower. Regardless of the type of foreclosure, your lender will serve you with a written notice to clear your outstanding debt, followed by a notice of default if you fail to make the payment, and a notice of sale. If you feel that the foreclosure is unfair or you need more time to clear the payment, you can contest a foreclosure in court. If you're facing a judicial foreclosure, a court will typically serve you with summons so you can make your case and challenge the foreclosure. However, if you're dealing with a non-judicial foreclosure, you'll need to take legal action against your lender to stop the process of foreclosure. In some states, the law requires a lender to provide their debtor with the option of reinstating the loan in order to halt the process. This allows you to continue living on the property after the notice of sale until the sale date, provided you settle the payments that you have defaulted on. You can also be granted the opportunity to clear the entire loan, although this is only possible if you can secure a substantial amount of money or refinance the home. If you are unable to stop the foreclosure, the property will be put on auction by a court so that interested individuals can bid for its purchase. However, if no buyer is found, ownership of the house will be automatically transferred to the lender. If you've not made plans to protect the house and are still living in it, you face eviction and should start looking for alternative accommodation. In most states, the law offers you a certain period within which you can reclaim your house after a foreclosure. This redemption period is usually indicated in the notice of sale. However, you will have to be willing to clear the loan payment in addition to the costs incurred by the lender during the process of foreclosure before you can reclaim your home. Consequences of foreclosure. Going through a foreclosure can pose serious challenges to you as a debtor. The most obvious outcome of a foreclosure is that you may end up losing your house and getting evicted. This means you'll be forced to look for accommodation elsewhere, renting a house, which will inevitably take a toll on your personal and financial life. Foreclosures are also generally very expensive processes that can make you lose a lot of money. When you default on your loan payments, your lender may charge you exorbitant late fees. In addition to this, you might end up incurring a lot of legal fees as you try to fight the foreclosure. Any extra fees that a lender imposes on you ultimately increase the amount that you owe them, and you may find yourself still indebted to them even after your house has been foreclosed and sold if the proceeds of the sale are not enough to cover all your debt. Similarly, a foreclosure can severely impact your credit score. Once a lender initiates a foreclosure, your credit score will reflect this a month or two after the proceedings have begun and will remain that way for up to 7 years. This can seriously hamper your ability to secure another mortgage loan, even though you may still be eligible for some government loans. In some cases, a foreclosure can also hurt your chances of securing employment. Filing a bankruptcy claim may temporarily stop a foreclosure from proceeding. However, the process is often very complex and may vary from state to state. It is therefore important to seek advice from a qualified attorney on the best course of action. In conclusion, Here are some of the key takeaways to remember from this chapter. Always respond to lawsuits and summonses, because if you don't, they likely get a default judgment against you. Lenders can resort to wage garnishments and seizing money from your bank account as a means of recovering the money that you owe them. Failing to clear your mortgage loans can put you at risk of losing your house and getting evicted. There are several steps that you can take to stop foreclosures and garnishments, including negotiating with your creditors, filing a bankruptcy claim, and debt consolidation or refinancing. In the next chapter, we will look at a range of strategies that you can deploy to frustrate or halt debt collection activity.